You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Well, have you seen housing prices up 20 to 30%, even in the most godforsaken areas of the country? Can it continue? Interest rates, is that going to be what destroys the housing market? Well, let's talk to our good friend from wolfstreet.com, Wolf Richter. Wolf, great to have you on. So what about this housing market, huh?
Thanks, Kerry, for having me back. We just got the numbers yesterday from the Case-Shiller index, and it is just stunning, the home prices we're seeing. But we're looking at the data today that reflects home purchases from late last year to early this year. So when rate locks were handed out at that time. So this is based on much lower mortgage rates than what we have today. So it's looking back. We're looking back at several months here. We don't. It's not real time. So back then, it was just incredibly, ridiculously crazy what was happening in the housing market.
Hey, you make such a great point, and so many of you investors out there make this mistake repeatedly. The old caveat, past performance is not indicative of future returns. Well, here, you always got to remember that any statistic you look at is history. It's not real time. Yeah, if we could tap into the computers of all the states and see the unemployment claims coming in as they're filed, we would know, or other things like that. If we could be getting the real-time economic statistics on retail sales, then we would know. It wouldn't be history. But when you look back at prices, et cetera, it's always a look back, and it doesn't mean that it's going to continue into the future. On the other hand, a trend in motion stays in motion, right? And trend is your friend until the end. We could be at the end here.
Yeah, when you look at the price spikes, everybody who just looks at them for a second knows that this can't go on. This is just it's just nuts. And it has to end. And when these kinds of bubbles end, they don't just plateau generally. They backtrack, and it's a slow moving thing. Housing market is very slow moving. Last one took 4 or 5 years to play out. The first year of it, when the bust came, we didn't even know it was a bust. There were the underlying dynamics, but we didn't have the charts to show what was going on until afterwards.
Exactly, and I'm attempting to share on the screen the 30-year fixed mortgage rate. Unbelievable. And I go down your article here and look at San Diego.
Yeah. It's crazy what's happening there.
Los Angeles and Seattle and San Francisco, and we go down by state, Miami. Now, we had a huge bubble. I remember they literally knocked down downtown Miami, built all these high rises in the early 2000s. And then we had that bubble there. And then, Tampa, even worse than Miami. And then we look at Phoenix. And, I was there over the weekend, and everything is just booming. The only one that was surprising was Denver. They never really had a bubble in the first place. But now, bubblicious, all these markets are bubblicious. And, it really puts this whole thing in perspective that, the tree, Benjamin Graham said it over 100 years ago, the tree does not grow to the sky, but maybe the skyscraper is going to grow to the sky in these metro areas here.
Yeah, no, we just know it can't go on. We don't really know when it's turning. And now today we're looking at, this is real-time data almost. We're looking at mortgage applications today that came out for last week. And, they have plunged. So we see that, the mortgage applications for purchases, so not for refinancings, but for purchases are down 17% from a year ago. And they're back where they were in May 2020 during the lockdowns. They're much lower than they were during the peak a year and a half ago. So this is real time. Refinance applications, they have collapsed. Obviously, that has a bigger impact on the overall economy because people, when they refinance, they either have a lower mortgage payment and they can spend this extra money on something else, or they get a cash out refi and then they have a lot of money to spend all at once on a car or boat or home remodeling or whatever. And all these things are helping consumer spending and the economy. So now that's getting shut down and got shut down because the refinancings have collapsed months ago. So they're now at very low levels, and the purchase mortgages, we can see that. I mean, that's so what you have to keep in mind. When you apply for a mortgage today, you get a rate lock generally. That's good for a certain period of time, maybe a month or 3 months, and then you've got that period to go shop for a house. So the rate locks that were handed out this week, they're going to turn hopefully into home sales in the next month or two or three, so that's one thing. That's where the delay comes in. So the mortgage applications we're seeing today that have plunged now, they are turning into lower home sales volume in the next month or two. We've already seen new houses, the sales volume come down pretty hard. Existing home sales are down. So that's already been playing out, but it's when you take layer after layer of buyer out of the market, sooner or later, you're going to have fewer potential buyers, and the sales volume is going to go down.
And investors, and a lot of these are flips. You have the whole supply chain issue with costs of materials, rapidly escalating. Another thing, I was talking to a realtor over in New York, where I used to live, is that foreclosures, once this thing hits the fan, the inclination now is to not foreclose on the property. The judge doesn't want to sign the foreclosure order. Certain states, you have these non-judicial states where the trustee just does a sale. You don't have to go to court. But the whole impetus behind the system of liquidating defaulted mortgages, selling off the properties, has all changed since the pandemic and the lockdowns, where nobody really wants to do a foreclosure. And I guess with rapidly escalating prices, you could get away with it because then they could just sell the property or perhaps refinance. That's all coming to an end as well. So the meltdown isn't just on the front end of people buying homes, but it's on the back end when they eventually default and the property goes into foreclosure.
And we got to keep in mind that when you have, as we've had, a 20 or 30% spike in prices, over the last 18 months, when prices come back down by that much, so that looks like a whole lot. 20% price decline, it sounds like a whole lot from existing levels, but it just takes you back there. So it's a relatively small number of mortgages that are actually impacted by this. So people that have bought a house during those 18 months, or especially towards the peak of that spike, or people who have refinanced and gotten cash out a maximum based on some appraised value, they're going to be impacted by a plunge in home prices of 20 or 25%. The rest of the housing market really isn't, because they bought before, and so they can sit this out. Now, when home prices go down 30 or 40 or 50%, it'll drag more homeowners into it. But the first 20 or 30% really aren't going to have a huge impact overall, because it's a relatively small number of home buyers that are involved in that, because we've had such a huge spike that the numbers, the volume numbers involved in this is relatively small. So we'll have to see a 50% drop or 40% drop in home prices for a broader range of homeowners to really get hit.
Yeah, it's like the subprime. It started with the subprime, and then it cascaded into the Alt-A and then the prime eventually. But rents don't show any signs of backing off. At what point do rents stop rising?
Yeah, rents is different. I mean, rents are based on what people can afford to pay, and people meaning people on wages. Not people that made a ton of money in the stock market. So, we've seen that in San Francisco. Rents are still down from the peak in July 2019, a whole bunch. And depending on what measure you're looking at, they're down about 20%. They've come up from the lows, from the pandemic lows, but they're still down a whole bunch, in part because there's just not, rents were extremely high before then, and there's still not a lot of demand. And working from home has taken a lot of people out of the city, and there's lots of empty apartments here. So, so you have that scenario. You have other scenarios in Miami and elsewhere where rents are exploding, and smaller towns, rents are exploding. But at some point, this stops because people can't afford to pay them anymore. And then the landlords can't fill their apartments, and they're sitting in vacant apartments for a few months. And then they decide, okay, I'm going to have to put somebody in that. And they're cutting their asking rents down to where they can find somebody. So rents are going to behave very differently, and they're probably going to react faster than home prices. Yeah,
I wouldn't doubt it. It's easier to cut the rent than the home prices, where you got so much into it and you don't want to take a loss. Yeah. I have a personal trainer, and she's in Palm Beach County. Her rent just went up $500 per month, doesn't want to get a roommate. So she's forced to move further north, further away, to get a reasonable rent. And at some point, the merry-go-round has to stop, because the market is going to dictate. Yeah. It was a landlord's market, and at some point it's going to turn into a renter's market. That always happens.
Don't just survive, thrive. The Financial Survival Network.
Trilogy Metals is a world-class developer in Alaska's Ambler Mining District. The company already possesses 8 billion pounds of copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and now over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% IRR. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades on the New York and Toronto exchanges under the ticker symbol TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah, and that this can turn pretty quickly. Rents are a much more liquid measure, and especially the measure that we're looking at is asking rents. These are advertised rents. It's not the actual rents people are paying currently in the rent-controlled apartments and in the apartments where they've been living for years, and the landlord doesn't raise the rents. And these are asking rents. And if they can't fill the apartments at these asking rents, they just chop the asking rent, And so you see the asking rents decline. That's the first measure you see. And the actual rents really haven't budged much, have neither gone up as much nor gone down as much. So the asking rent factor is like the price is advertised in the store. And so if a store wants to sell more, they'll put it on sale. And that's what we'll see. And when they run out of people to put in these high-priced rentals, they're going to have to reduce the asking rents.
All right. So I want to talk about used car prices, because we saw the first decline. And I know my daughter had a car that it was the end of the lease. If it had happened in a few months ago, in November, December, she would have had equity in the lease of about $4,000 or $5,000, which is a substantial amount on that car. But because she was turning it in this month, maybe there was $1,000. It just wasn't worth doing anything with. You had an article about Carvana, which is a car vending machine, just a gimmick, basically, in my opinion, as a pretty astute car buyer. But the used car market looks like it's tanking. Is it a precursor to the housing market?
And so I've worked in the car business back in the 80s and 90s, in a big dealership, and I ran it. And so this is close to my heart, and I've never seen anything like this before, not even close. I mean, the way used car prices have spiked by 40% year over year, according to our CPI measures, and by other measures, by our wholesale measures, we'll go to the auction at similar rates. I mean, it was just gigantic. You could buy a new car. If you could get a hold of a new car, it would be priced lower than the used car. Yeah.
I know.
Completely nuts. And so now we've got that, and there's never any shortage of supply. There were always enough used cars. Didn't have a flood of used cars on the market, but there was plenty of supply, unlike new cars. New cars we really ran out of, but used cars there was supply. And so I saw this spike, and it started in 2020, really late 2020, early 2021, and I thought, my God, that can't be true. These people are paying crazy prices for these cars. And so now that's unwinding some, so we see some weakness in the wholesale market, and prices come down a little bit. And now they're not that weak anymore. They're starting to tick up again. So it looks like they're going to wobble lower. And depending on the model, they're on the retail side, there could be more movement. I don't think they go back to where they were. I just don't see that. It's just, I think there's just they're going to unwind part of it, and then and then go from there. And it could be that, when you have a 40% price spike and you come down half of that, that's a pretty good hit, like your daughter was experiencing. But, I don't think we go back to the prices that we were, this is a huge problem for people, for companies like Carvana and other retailers, used vehicle retailers that have inventories. They have these high priced inventories that they have a lot of money in them, a lot high cost. When the prices are coming down, they're losing money on the inventory. And, that's an issue to watch out for, especially, the companies like CarMax, they've been through this a million times, they know how to handle this. But these startups like Carvana or Vroom and some of the others, that could be an existential crisis for those companies.
Yeah, it's going to hit CarMax too. Hey, one thing, we're talking about the car industry, the auto industry. Just today, somebody announced that Tesla is no longer offering a buyout on their leases as of, I think it was either the 15th or the 22nd of April. They said in their online material that as of that date, no more buyouts at the end of the lease. And Tesla's in the obviously enviable position as they can't build the cars fast enough for the demand globally. That could change quickly too, let's face it. But that I found really fascinating. So basically, these are all open-ended leases. You just rent them and then you give them back at the end.
And the Teslas have held up really well in the wholesale market too. So, the buyouts are at prices that are written into the lease at the beginning of the lease. So when the buyout is a good deal, customers usually do it. And when it's a bad deal, customers don't. So now when Tesla removes that option for the customer to buy the vehicle at that fixed price, it indicates that Tesla can probably sell it for quite a bit more than the buyout value. And that makes sense for other automakers. Tesla really controls the leases. There's not an independent leasing company out there. So, they can do that more easily. And other automakers may follow. There is a shortage of new cars. They all have the same problem. Tesla has somewhat less problems than other car makers do, but none of them can build what they can sell. And, they all have all kinds of backlogs. They've got unfinished vehicles sitting by the hundreds of thousands around waiting for parts. So I can imagine that move will be duplicated by other leasing companies and captives. I think it's from a business point of view, that's a good idea,
Well, there's so many of their cars used to be these auto companies. They put in all the promotions, 0% discounts, rebates, all this stuff. And they'd wind up being underwater on those cars, the lease cars, as they were surrendered. I remember when Infiniti started out, they said they literally put $5,000 in the trunk of every Infiniti that went out the door on a lease. So now the car automaker is in the enviable position that what was a losing proposition, their lease surrenders, are now a profit center. And Well, we'll see how long that continues for.
It makes sense, when you think of used car prices having jumped by 40% in a 2-year time span. I mean, that's the value that when you took out a lease 2 years ago, so the lease turn-in would have jumped 40% in value, comparatively speaking, to what you would expect. And they all have, I know people who've bought out the leases and they got incredible deals. Late last year, I mean, it was like, wow,
It got to the point where the automakers wouldn't allow like the CarMaxes, the Carvanas, or any of them to actually do the buyout. The consumer had to do the buyout themselves, and then they could sell it off to a used car dealer. But interesting times. And then no discussion of any of this would be complete without talking about inflation, stated rate, actual rate, because all of it's tied in, isn't it?
Yeah. So, I mean, everybody has a different rate of inflation, and the government issues a whole slew of different inflation measures. And the highest one it issues is CPIW, which is 9.5% roughly. CPIU, which is the headline that we constantly read about, is 8.5%. I mean, these are huge numbers, and they probably don't reflect the actual cost of living increases that most people have experienced. Some people have lower inflation rates. Over here in San Francisco, inflation really hasn't happened that much because rents have gone down, and so, but like in Miami, you got housing costs shooting through the roof, and so you're looking at a double-digit inflation picture right there. I mean, even according to government statistics, there are now a number of cities in the United States, including Miami, where inflation, the official CPI, is double digits, and that's huge. I mean, most Americans have never lived as an adult through this kind of period. We don't even know people who work in finance. They have no idea.
If you were born like after 1970, you might have lived through it, but you were a baby. You don't remember. But you and I have memories here of near hyperinflation. Inflation really losing control, required 20% interest rates to knock it down, to subdue it for a while, partially or mostly subdue it. The inflation measure is always suspect in this day and age. But now these people, a whole new generation, is learning about consumer price inflation and declining purchasing power of their currencies. And this is a global phenomena too, right? It's all over the world.
Yeah, that's a little bit different than it was in the 1970s. It was an oil shock, and countries that weren't so dependent on oil as the United States, had less of an inflation problem. Now it's global, it's much broader. Yeah, energy is involved, commodities are involved, but now it's services, it's gone into housing costs, it's gone into all kinds of things. And the inflation we've seen in new and used vehicles, that's going to top out, but now it's rents and all kinds of other stuff that's pulling in. So, and this is in Europe, it's in parts of Asia. We're seeing inflation in the Middle East. It's going everywhere. Now, China has its own problems. They have a demand issue now. They've got lockdowns, and they've got the property development sector collapsing, and they've got consumer demand going down. So they have less inflation pressures than many other places, but they have an economic issue there. A unique economic issue. And
very true.
But this is a global issue now.
Global issue. Everybody's learning about. Eventually, hopefully, they'll learn about Ludwig von Mises and Hayek and all of them. So maybe we will learn something from history. Although the one thing we always learn from history is we don't learn from history. But you and I remember these days, so it's interesting phenomena. Well, in any event, go over to wolfstreet.com. Must reading. You want to find out about what's really happening with inflation, what's really happening with housing prices, what the markets are really telling you. Then I suggest you go over there. If you got a question for Wolf, shoot me an email, kl@kerrylutz.com. Wolf, always a pleasure. Thanks so much for coming on.
Thank you, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.